welcome to Friday's Financial Fitness. I've talked in the past about companies buying their stock back, but today I would like to go into a little bit more detail about this because we saw a record number of repurchases in 2018. According to Investopedia, companies buy their shares back in the open market by using its cash to buy their own shares. In other words, they're investing in themselves. So what's the outcome of companies repurchasing their shares? The number of shares outstanding are reduced because they're buying their shares back, and indirectly, the relative ownership stake of each of the current investors increases because there are fewer shares outstanding. So, why would companies buy their stock back? Some companies have indicated that it's the best use of their capital. In other words, they indicate they don't see any better investments than themselves. They also feel that the stock has been beaten up and that it's undervalued. Another reason is they feel it may help their overall financial ratios. If they're buying their stock back, it typically is going to increase their return on assets because they've used cash that is actually an asset and it has been reduced. It should also increase their return on equity, and if they continue to make the same amount of money, their overall earnings per share will also increase, which in turn means their price to earnings ratio is reduced. And normally, the market likes a lower PE ratio versus a higher PE ratio, meaning their stock may look more attractive. As I mentioned at the beginning, according to the Standard & Poor's, 2018 was a record number of stock repurchases by companies as they bought back a total of $806 billion of their own stock, beating the previous record that was set in 2017, where the total was $589 billion.